This is the Scrap Metal Commodities Recycling Report by BENLEE and Raleigh Goldsboro Recycling, December 19th, 2016. Last week, commodity prices and economic reports were mixed. U.S. steel production rose the most in 11 months and is at its highest level in 5 months. Related capacity utilization is 71%, the highest in about 14 weeks, which is a major reversal from last year when steel production was in a major decline. Due to the continued improving U.S. economy, the U.S. dollar hit a nearly 14-year high. A strong U.S. dollar causes commodities sold in dollars to go down in price, which we saw in some cases just this week. Oil prices held at $51 a barrel as OPEC and non-OPEC countries claim they will cut production. Also, the International Energy Agency released a report that with global growth continuing, they are increasing their oil consumption growth forecast by 110,000 barrels a day. The oil rig count rose to 510, up a huge 61% from the 316 low of a year ago, but still down an even bigger 68% from the 1609 of 2 years ago. Oil over $50 is helping bring increased U.S. production and related steel and equipment jobs. Iron ore closed flat at about $80 a metric ton. Iron ore is more than double the $37 per metric ton of earlier in the year, bringing upward pressure on related commodity prices. The scrap ferrous price run-up in recent weeks is being driven by higher U.S. demand, tight supply, and good exports. Despite higher scrap prices, reports remain of only small increases in incoming scrap metal into yards. So if scrap metal continues to increase in demand, prices could rise further, but the strong U.S. dollar makes U.S. exported scrap expensive and makes imported scrap from Europe to the U.S. cheap. This means we could expect barges of scrap metal to be coming into the U.S. from Europe, which will help keep prices somewhat stable. Hot-dip galvanized steel at $850 a ton is up over $150 a ton from just 10 weeks ago, an incredible move in such a short period. Stainless 304 held steady at 33 cents, with actually little news. Copper fell 6 cents to $2.56 a pound on limited demand increases and the strong dollar, and it's down another 5 cents this morning at $2.51. Spreads on COMEX continue to open as demand remains good, but not great. Copper inventories jumped, also putting downward pressure on prices. We saw aluminum fell a penny at 78 cents, yet we're up nicely for the year on higher demand and the need to push through higher raw material and production costs. Aluminum inventories continue near their 9-year lows, which could help stabilize prices. Look carefully at the bottom right of this graph. The U.S. Federal Reserve raised interest rates for the second time in 10 years. This quarter-point increase means rates are shockingly low compared to where they were 10, 20, and 30 years ago. Consumer prices in November rose year over year to 1.7%, the highest inflation in over 2 years. Energy and commodity price increases in recent months are key drivers, which is a reason for the higher interest rates by the Fed. In a twist, despite higher U.S. growth, U.S. capacity utilization remains declining, falling to 75% in November, the lowest since March, which will help keep inflation low. Low utilization means that there can be major production increases with minimal spending on new equipment. This will continue to bring a slow growth economy and keep prices somewhat stable. Housing starts fell a large 19% from their 9-year high last month. Higher interest rates are partly a reason for this. The market flash U.S. manufacturing PMI report rose to 54.2, the fastest in almost 2 years, based on strong employment, while output and new orders expanded at a slightly slower rate. With that, we hope all have a safe and profitable week. And lastly, happy holidays to all.